While declining revenues for state and local governments are creating serious concerns for financial analysts and market makers. Banking analyst Meredith Whitney says muni defaults could total hundreds of billions of dollars. Meantime, PIMCO's Bill Gross, who manages the world's largest mutual fund, doubts the number will be that high. So who's right in this debate? Let's ask Lyle, Fitterer, who manages about $25 billion in muni assets for Wells Capital Management. Morningstar, by the way, rates him the best muni manager for the past decade, and Bloomberg ranks him among the top managers for the past 1, 3, and 5 years. So perfect, great track record. Lyle, perfect person to talk to. So who's right in this debate? Is it going to be as bad as Meredith Whitney puts out there, or maybe not so bad as Bill Gross suggests?
We would side with Bill Gross on this one. We don't think it's going to be as bad as Meredith does predict. I think in terms of numbers of defaults, we would agree with Meredith that they're going to be higher than they have been historically. But in terms of absolute dollar amounts, the default rates have actually been declining, and we don't see them picking up substantially in the near future.
What gives you that confidence that those default rates will not pick up substantially in the future? Because when you pick up article after article, I think about some of the papers over the weekend talking about the deficits at so many of our nation's states and how many municipalities are struggling. What gives you that confidence to say that they're not going to be rising defaults?
I think a few different things. One would be just the simple fact that muni revenues tend to lag the broader economic cycle by about 12 to 18 months. So we're about 18 months plus off of the bottom of the economic cycle, and you're actually starting to see an increase in muni revenues. If you look across all states, revenues were up year over year consecutively for the last 3 quarters. I believe the last quarter they were up about 4.8%. And if you look specifically at property taxes, which impact local municipalities much more than other taxes, they have not gone down at all, and they've actually continued to rise over the last few years.
I don't know if you noticed, Lyle, but today in the op-ed section of the Wall Street Journal, there was one story saying bankruptcies for states, a very bad idea, and another one that said even suggesting bankruptcies for states is a horrible idea. I feel like when those two articles appear in the same paper on the same day, that bankruptcy for state is going to be something that we talk about a lot more going forward. What do you think about the idea?
I disagree with the idea. I think it's somewhat of a silly idea. People are throwing it out there at the national level. I think if you talk to state governors or you talk to state treasurers or local mayors, I think they would all disagree. What it basically does is it simply creates even more fear and actually drives up costs for municipalities when in fact there are very few municipalities that would even think about filing bankruptcy. The cost of a bankruptcy, as Vallejo found out, is very, very expensive. And the actual savings, when you look at the debt and the debt payments as a percent of their fund revenues, is relatively small. So it doesn't accomplish a lot other than maybe helping them renegotiate their pension and union contracts. But those are things that other states have started to negotiate and have had success with without using the word bankruptcy.
All right, so you're not so pessimistic, not at all, versus some of the other folks, Lyle, that are out there. So where would you be investing at this point? Because looking over my notes, I mean, there's some interesting places that you're actually committing money at this point.
Yeah, and again, I think they're depending upon your risk parameters. You can stick with very high quality munis. They've become very attractive. You can buy 10-year munis at basically 100% of the yield of treasuries. And again, there are some states out there and some local municipalities that are AAA rated. They've done a great job managing their finances. If you want to go down in credit a little bit, you know, we've been putting some money to work in states like California, some of the state GOs, but even some of the school districts, the stronger school districts there. The state GOs, if you look at them, I think today they were trading roughly around 6% on a tax-exempt basis. In 30 years, if you gross that up for taxes, that's 9 to 10% depending upon your tax rate, which is very compelling, not only relative to other fixed income asset classes, but even relative to the equities as a long-term investment.
Do you stick with, by the way, purely tax-exempt investments here, or do you think that Build America bonds offer some advantage as far as yields are concerned?
Well, for the products that we manage, we're primarily tax-exempted buyers. We do have some crossover accounts that can use BAB, so we will look at them and we help out our taxable guys on them. And ironically, they've performed very, very well. If you look back, they kind of peaked in terms of their yields relative to treasuries in the middle of December, and they've come down ever since. They've been one of the best performing fixed income asset classes over the last 4 to 6 weeks. which is, in the face of munis doing very poorly. So here's a large constituent of buyers who thinks there's a lot of value there, and they've been bidding up these bonds in the marketplace.
Bottom line, Lyle, don't rule out the municipal bond market. That's your message here, just quickly.
Very quickly, yeah. I think that it's a great place to invest. I think, unfortunately, there's been a disservice done to investors, and they should actually be buying, in my opinion, rather than looking to exit at this point.
All right, great to get some time with you. Lyle Fitterer over at Wells Capital Management.